wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the global financial markets. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 215. And in this episode, we are reviewing the performance of the financial markets during the 22nd week of 2026, and that is from Monday the 1st to Friday the 5th of June. And without further ado, this is your host Jamhuri, and together let's dive right in. We kick it off in the United States, where the Bureau of Labor Statistics reported on Friday that jobs growth in the United States surged unexpectedly in the month of May as the U.S. labor market continued to post a solid year of expansion. Non-farm payrolls jumped by a seasonally adjusted 172,000 jobs in May, which was down slightly from an upwardly revised number of 179,000 jobs in April, and was way above the Dow Jones consensus estimate for just 80,000 jobs. However, despite the surge in jobs, the unemployment rate held steady at 4.3%. This report came against a background of muted expectations as most employers held their ground in a low-hire and a low-fire job environment. While job gains have largely been concentrated in just a few sectors, there are signs that artificial intelligence is beginning to have a negative impact on the labor market. In addition to the strong jobs number for the month of May, revisions for previous months also painted an even better picture of the labor market. Case in point, April's jobs number was revised upwards by 64,000 jobs, while the jobs report for the month of March received a boost of 29,000 new jobs. And over to the Eurozone, where official data released on Tuesday showed that Eurozone inflation rose to an estimated 3.2% in May, driven by double-digit energy price growth. This inflation number, which was in line with forecast, is expected to lock in expectations of an interest rate hike at next week's European Central Bank policy meeting. According to flash data, energy costs represented the highest annual rate of inflation in May, with prices rising by 10.9%, which was a slight increase from 10.8% that was recorded the previous month. Inflation rates also varied drastically between individual markets, with Germany, which is Europe's largest economy, seeing annual inflation fall to 2.7% in May, down from 2.9% in April. However, in France, annual inflation rose from 2.5% in April up to 2.8% in May. This latest data showed that inflation in Europe is continuing to rise above the European Central Bank's 2% target rate as oil and gas prices remain elevated in the wake of the US-Iran war. Prior to the outbreak of the conflict in Iran, inflation in the Eurozone had dipped below this 2% target rate. According to LSEG data, markets are currently pricing in a 94% chance of the ECB hiking its key interest rate by 25 basis points at its policy meeting later this month. Over to the Far East, where Japanese Prime Minister Sanai Takaichi is compiling a supplementary budget to help households with the cost of living, but this has also created skepticism about whether she can stick to her promises about debt issuance. The supplementary budget was largely in line with market expectations and stood at about 3 trillion yen, but comes as Japan still struggles with higher energy prices, rising subsidy costs, and a weak Japanese yen. According to Bloomberg, the budget also marks a reversal from her earlier position that extra spending was not required. The Prime Minister has also said that the total bond issuance for the calendar year of 2026 would remain unchanged from the original budget plan. Takaichi has sought to dispel worries in the bond market, saying that the extra spending would be financed by issuing deficit-covering bonds. However, after reports that the government may issue fresh debt to fund the extra budget, the yield on the 10-year Japanese sovereign bond rose to 2.809%, which is its highest level since 1996. And over to China, where, according to a private survey released on Monday, China's manufacturing activity expanded faster than expected in May, although growth slowed from the previous month and contrasted with softer official data pointing to weaker momentum in the manufacturing sector. The China General Manufacturing Purchasing Managers Index, compiled by S&G Global, came in at 51.8, a touch above 51.6 that was projected in a Reuters poll. This reading was down from April's 52.2, indicating a slower pace of improvement in manufacturing conditions. However, according to data released on Sunday, China's official manufacturing data showed that the Purchasing Managers Index for May fell to 50 flat, down from 50.3 in April, which was its lowest level since a print of 49 in February. Overall, the official PMI data suggests subdued manufacturing sector growth, increased services activity, and continued decline in the construction industry. For your information, with PMI data, a reading above 50 indicates an expansion, whilst a reading below 50 denotes a contraction in manufacturing activity. On Wall Street this past week, U.S. equities tumbled on Friday following a violent sell-off of chip stocks. The tech-heavy Nasdaq Composite lost 4% for its biggest decline since the tariff turmoil of early 2025. The turn higher in bond yields also weighed on the stock market as traders sold tech stocks and took a risk of posture, fleeing towards defensive sectors such as consumer staples, which are companies that produce essential everyday goods. The catalyst for the sell-off in chip stocks was unclear. However, a spike in Treasury yields following a much stronger than expected jobs report for May did not help the sell-off. The broad market S&P 500 lost more than 2% during the week for its first negative week in 10 as it fell by 2.64% on Friday before closing at 7,383. Following Friday's losses, the tech-heavy Nasdaq Composite tumbled by 4.7%, recording its biggest drop since April 2025 before settling at 25,709. Meanwhile, the 30-stock Dow Jones Industrial Average was modestly lower for the week, but still dropped by about 695 points on Friday as it came to a close at 50,866. In the U.S. government bond market, Treasury yields jumped on Friday after a stronger-than-expected May jobs report reinforced the view that the U.S. labor market remains resilient and dampened any expectations for rate cuts this year. The stronger-than-expected jobs report drastically reduced the likelihood of interest rate cuts from the Federal Reserve in the near term. On the contrary, according to the CME's FedWatch tool, the odds that the central bank policymakers would hike interest rates by the end of the year rose to 70%. The yield on the 2-year Treasury note, which is more sensitive to Federal Reserve policy expectations, climbed more than 11 basis points to 4.162%, reaching its highest level since February 2025. Meanwhile, the yield on the benchmark 10-year Treasury bond, which influences borrowing costs on mortgages and other consumer loans, rose more than 6 basis points to 4.544%, which is its highest level since the 21st of May. For your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions. In the commodity markets, oil prices fell on Friday as traders gained confidence that renewed conflict between the U.S. and Iran would be short-lived and was unlikely to escalate further. Even in the absence of a peace deal, the market is not seeing any escalation between the parties. The Petroleum Development of Oman said operations at one of its major ports, through which it exports about 900,000 barrels per day, remained unaffected by recent explosions and confirmed that oil loading was continuing uninterrupted. Both major contracts rose earlier in the week after fighting flared in the Middle East as peace talks between the U.S. and Iran dragged on, while traffic through the Strait of Hormuz, where 20% of global oil supply passes through, remained limited. Both contracts still looked set to post their first weekly gains in the past 3 weeks, with Brent up about 1%, and WTI rose by around 3.1%. Brent crude was down by 2.04% and settled at $93.09 a barrel, whilst the U.S. benchmark West Texas Intermediate was down by 2.69% to close the week at $90.54 per barrel. In the precious metals market, the price of gold fell on Friday after a stronger-than-expected U.S. jobs report reinforced expectations that the Federal Reserve will most likely keep interest rates higher for longer amid inflation concerns fueled by the ongoing war in the Middle East. In light of the ongoing conflict in the Middle East and the increase in energy prices and the knock-on effect on inflationary pressures, it is highly unlikely that the Fed will cut interest rates this year. According to the CME's FedWatch tool, markets are currently pricing in about a 70% chance that the Fed will hike rates in December. Bullion has fallen more than 16% since the U.S.-backed war against Iran began in late February. The conflict has led to a surge in oil prices and stoked fears of inflation and higher interest rates, which has weighed down on the price of gold given its non-yielding status. Spot gold was down by about 3.6% during the week before eventually closing at $4,375 per ounce. In the cryptocurrency market, Bitcoin extended its losses on Friday, dropping to lows last seen in October 2024 to cap what was a bruising week for crypto investors. Crypto-related companies such as Coinbase, Circle, and Strategy each lost about 8% on Friday, with Strategy falling by 26% during the week, and Coinbase was also on track for a 20% weekly loss. The decline began after Strategy, which has been a major advocate for Bitcoin as a treasury asset, sold a small amount of its Bitcoin holdings, weighing on sentiment and forcing hundreds of millions of dollars in liquidations that accelerated the downside pressure on Bitcoin. As at Friday's closing bell, the flagship cryptocurrency was on track for a weekly loss of 17% and was last seen hovering around $60,450 per coin. And in the African markets, South Africa's central bank governors said on Tuesday that the bank would bring inflation back down to its 3% target rate, defending last week's rate hike as necessary in order to prevent second-round effects from the Middle East oil shock from becoming entrenched in the economy. On Thursday the previous week, the South African Reserve Bank raised its key repo rate by 25 basis points to 7%, with 4 out of the 6 committee members supporting this decision. South Africa's inflation climbed from 3.1% in March to 4% in April and is now sitting at the upper end of the central bank's target range. The South African Reserve Bank, which targets inflation at 3% with a 1 percentage point tolerance band, raised its inflation forecast for 2026 to 4.4%. And just for your information, Africa's most industrialized economy is a net oil importer and has seen massive price hikes on the back of the ongoing war in the Middle East. We now change scene to the Kenyan financial markets, and as is the norm, we start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling continued to trade broadly sideways versus the US dollar. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.37 compared to a rate of 129.52 that was recorded the previous week. Meanwhile, the sterling pound was priced at 173.71 and the euro was valued at 150.11. And on the regional front, one Kenya shilling was changing hands for 29.10 Ugandan shillings and 20.30 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.31. The International Monetary Fund has previously raised concerns about the extreme stability of the Kenyan shilling, but the central bank continues to insist that it operates a floating exchange rate policy. However, the data tells a different story, as the dollar-shilling rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenyan shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 65% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves held steady for a grand total of $13.20 billion, which is equivalent to 5.6 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default, which the country came close to in June 2024 with the maturity of Kenya's debut Eurobond for $2 billion. In the money markets, during the past week, the interbank market was sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as a Kenya shilling overnight interbank average, aka Kesonia, this is the rate that banks used to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate remained unchanged at 8.75%, which is in line with the central bank rate at the same level. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio that is currently set at 3.25%, this averaged at around 16 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies a percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 4th of June, and the central bank received bids totaling to 54.5 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 227%. The central bank accepted almost the entire amount of bids received, and the results of the auction were as follows. The 91-day rate resumed its upward trend, rising by 17 basis points to settle at 8.55%, whilst the 182-day rate corrected sharply, increasing by 27 basis points to close at 8.52%, and the 364-day rate also inched up by about 14 basis points to average out at 8.76%. You may have noticed that over the past 5 weeks, the yield on the short end of the Treasury bill market has been rising steadily, and this is on the back of the first supplementary budget for 2025-2026, which pointed to a massive increase in the domestic borrowing target of about 360 billion shillings. In addition to that, the latest data shows that inflation is now trending higher, mainly due to the impact of rising fuel prices. Given this backdrop, we should therefore expect more upward pressure on interest rates as investors park their funds into the 91-day Treasury bill, which gives them an opportunity to invest at a higher rate in the short term. In the primary bond market, last week, the Central Bank of Kenya published a prospectus for the reopening of 2 fixed coupon treasury bonds, in which it was looking to raise a total of 40 billion shillings for the stated purpose of budgetary support. The auction for these bonds was held on Wednesday, the 3rd of June, and the central bank received bids totaling to 34.3 billion shillings against the advertised amount of 40 billion shillings, representing a performance rate of about 86%, and the results of the auction were as follows. For the first bond, which is a 15-year bond that was initially issued in 2020 and now has 8.7 years left to maturity, the central bank accepted 20.1 billion shillings at a weighted average rate of 13.31%, and this bond matures in February 2035 and has a coupon rate of 12.75%. And for the second bond, this is a 25-year bond that was initially issued in 2018 and now has 17.1 years left to maturity. The central bank accepted 14.2 billion shillings at a weighted average rate of 14.23%, and this bond matures in May 2043 and has a coupon rate of 13.40%. Up next is our topical issue, and this week we're looking at the increased interest in sustainability bonds in the Kenyan market. Kenyan investors have lately shown an unusual appetite for a new class of debt instruments that promise both financial returns and measurable social and economic impact. In May this year, the Kenya Mortgage Refinance Company raised 3 billion shillings through a sustainability bond that attracted bids worth 9.38 billion shillings, which was more than 3 times the amount that was offered. And a few months earlier, Safaricom had raised 20 billion shillings through a green bond that attracted bids worth 41.4 billion shillings against an initial target of just 15 billion shillings. A sustainability bond is a debt security through which an issuer borrows money from investors and commits to using those proceeds exclusively for projects that generate both environmental and social benefits. Unlike a conventional corporate bond whose proceeds can be used for general business purposes, a sustainability bond requires the issuer to clearly disclose where the money will be invested and how it will be managed and how the impact will be measured and reported. Under the Sustainability Bond Guidelines issued by the International Capital Markets Association, the proceeds must finance a combination of eligible green and social projects. Examples include affordable housing, energy-efficient buildings, climate-resilient initiatives, water projects, and programs that improve access to essential services for underserved populations. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamhuri@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, a ship in the harbor is safe, but that's not what ships are built for. A quote by John A. Shedd. Think about it. Thank you, and God bless.